Hey folks, buckle up, because last week was a wild market ride. We saw significant volatility with worrying economic signals and big policy announcements shaking investor confidence. We'll examine the economic data, the stock market's reaction, and key events on the horizon. First, let's discuss the overall economic picture. In the US, we got the final Q4 2024 GDP growth reading, which came in at 2.4% annualized. That met expectations, but it suggests that the economy is slowing down. Adding to this, consumer sentiment has taken a hit. The University of Michigan's March reading dropped to 57, the lowest since November 2022. This reflects growing concerns about inflation and the labor market's strength. These soft measures may lead to lower consumer spending and slower growth. And speaking of inflation, the core PCE price index, which is the Fed's favorite inflation gauge, rose by 0.4% in February, exceeding the 0.3% that was expected. This fuels concerns that inflation might stick around longer than we'd like. Now, it's not all bad news. Weekly jobless claims did edge a bit lower, which suggests that the labor market still has some resilience. But overall, the economic data is giving us mixed signals. And it's not just a US story. We're seeing uncertainty globally as well. China's big state-owned banks announced they're raising significant capital to support their economy, and the UK's budget watchdog lowered its growth forecast for 2025. All of this economic uncertainty took a toll on the stock market last week. US markets experienced some severe turbulence. The S&P 500 had a rough day on Friday, falling by 2%, which made it the second worst day of 2025. The Dow Jones Industrial Average also took a big hit, dropping over 700 points. A lot of this downturn was driven by those hotter-than-expected inflation numbers, but also by renewed fears about President Trump's tariff policies. Tech stocks got hit pretty hard too. The Nasdaq Composite and Nasdaq 100 both declined, with big names like Amazon and Microsoft seeing sell-offs. The president's announcement of a 25% tariff on imported autos and parts intensified those trade war worries, pushing the S&P 500 toward its worst quarter since 2022. In times like these, investors tend to flock to safe haven assets, and we saw that last week, with gold prices surging past $3,100. Let's take a quick look at some specific company news, because it highlights broader economic concerns. Lululemon's shares plummeted after they gave weak guidance for 2025, citing concerns about reduced consumer spending. FedEx also experienced a significant drop after a disappointing outlook, which raises concerns about shipping and a potential economic slowdown. Nike also fell after a sales warning, adding to those worries about discretionary spending. Interestingly, Boeing was a bit of an outlier, gaining 4% as the U.S. Department of Defense this month selected Boeing to lead the development of the Air Force's next-generation fighter jet, the F-47, a multi-billion-dollar award, bucking the overall market trend. And then you have Dollar Tree, which rose 11%, climbing back into positive territory for the year. Finally, automakers, both in the U.S. and internationally, saw sharp declines after Trump's auto tariff announcement. Looking ahead to this week, all eyes will be on President Trump's tariff policies, which are set to dominate the economic landscape. April 2nd is a big day, dubbed Liberation Day by Trump, as the administration is expected to impose reciprocal tariffs on several of America's trading partners. But don't expect the tariff news to end there. We'll likely see ongoing announcements as bilateral negotiations and sectoral tariffs are introduced. This could mean even more uncertainty for businesses and consumers. Amidst the tariff drama, we'll also get key labor market data for March. This will be the first clean read on the Trump 2.0 jobs market, as weather issues in January and February may have skewed earlier reports. So, watch Friday's non-farm payroll report, which could show a healthy rebound. However, it's important to note that there are predictions that monthly payroll gains may decrease in Q2 and Q3 as businesses potentially slow down hiring. Specifically, here are some of the labor market indicators to watch. We'll be looking at announcements of layoffs and initial jobless claims to confirm any job losses. March's unemployment rate is expected to remain at or below 4.2%. February's JOLTS report will give us insights into the pace of hiring amidst the Trump 2.0 uncertainty. Beyond labor, we'll also get March's ISM non-manufacturing PMI, which is expected to remain strong, and March's ISM manufacturing PMI, likely to show a worsening outlook. Finally, on the trade front, February's trade report will reveal that imports remained at a record high, with gold imports playing a significant role. There are expectations for the deficit to decrease in Q2. To sum it all up, the coming week will be crucial. The interplay between U.S. economic data and trade policies will determine the direction of the markets. Investors should brace themselves for continued volatility as we navigate these inflation fears and geopolitical uncertainties. Don't forget to like and subscribe for more market updates. And let me know in the comments what you think is the biggest risk to the market right now. Cheers.